Okay, investors, V-bottoms in stocks, no one gets in. I'm confessing that I waited until Monday afternoon to write this one, as I wanted to see if there was a weekend China trade deal and if President Trump's third call over the last 4 weeks to buy stocks would prove to be as good as his first 2 calls. Of course, now we know over the weekend there was a big reduction in tariffs and from China and what looks like a big walk back of verbal hostilities between the 2 countries. And on Monday, stocks exploded higher, led by higher growth technology stocks and semiconductors, up 4.5% to almost 10% in many semiconductor equipment names. The S&P 500 gained over 3.25%, and the laggard was the slower growth Dow Jones 30. As we had previously postulated for weeks in our videos, looking back, April 7th was the low for the overall S&P 500 index and U.S. stocks, much to the dismay of those calling for crashes, retest of the lows, trading ranges lower, or worse yet, those blown out on margins at the lows, or investors who panicked and went to cash late in the move down. As we discussed in our prior 3 episodes, a few periods like the Great Financial Crisis in 07-08 and the popping of the speculative dot-com bubble frenzy in 2000-2001, which did precede longer and deeper recessions, history says that enough damage had been done and many hedge funds got zeroed out on the lows and many retail investors have been buying the correction. The Zweig breadth thrust on April 24th created the first of what many chartists call a bullish island reversal pattern, and the tariff deal over the weekend created a second island reversal higher, leaving those longing for lower prices to get back in, desperate to buy or cover their shorts. On Monday the 12th, just yesterday, we blew right back through the 200-day moving average, which many had predicted would stop us. History being on the side of the bulls said calls for the retest would be wrong. We've given you the data on the Zweig breadth thrusts, investor sentiment data, and VIX spikes and retracements over the last 3 weeks. You can rationalize why markets have V-bottomed since early April on the walking back of tariff extremism, better jobs, and slower wage inflation data, but viewers who know me know I like real-time market data. The bond market data since early April was saying real growth was okay, and inflation peaked in early April, not the stagflationary doom bias calls many have suggested. Investors, like it or not, this is what Goldilocks for stocks looks like in the bond market. The components inside the treasury market were saying it's better to buy growth stocks than hide in boring stable names. And boom, a new story hits that corroborates what the real-time market data has been saying if you're watching closely. Investors, once again, I'll leave you with an update on how the charts look versus a similar period that was mid.com in 1998, not peak.com. I feel compelled to do this, showing this chart because Charles and I listened to dozens of technology conference calls the last 3 weeks that were positive on the continued AI build-out growth for the next 12 to 18 months. And most of the stories I read in the financial media are pending an AI doom collapse, which isn't happening yet. Secondly, investors, I haven't been able to find anyone who believes this analogy or will spend any time researching it. Remember, the late third quarter, 1998 long-term capital market hedge fund blow-up period, which was mid.com build-out, what we previously referenced when the S&P 500 dropped over 21%, tech tanked, semiconductors dropped, and the dollar fell minus 10%, was also one of these periods of a death cross. Take a look at the overlays of the S&P 500 and a very cyclical SOX semiconductor index back then and now. It'll be fun to see how this plays out over the next 9 to 15 months. Investors have rarely been this fearful and sentiment rarely this negative, and historically, when it's been at these levels, you've been better off buying, particularly as we've mentioned growth stocks, and walking away for 12 to 18 months than selling. I titled this video, V-bottoms, no one gets in, because historically speaking, if you didn't buy the first 10 days after the lows in April 7th or 8th, you missed your best chance during the sell-off. The market has behaved almost exactly as it has the last 15 years during event-driven sell-offs that reach bear market levels without the likelihood of an earnings or economic recession like we got in 2022. What's that? We spent exactly 2 months to the day breaking the 200-day moving average, then regaining it. Count the days, then go back to our previous comparison in late 1998 with long-term capital in October 1998 blow-up event, and count the days. 2 months to the day. While it would be normal to digest these gains next week or pull back in a minor way, I wouldn't expect a large percentage decline hoping to buy lower in the second quarter. Historically, these moves have led to frustratingly bullish lurches and grinds higher for about 3 months before the market finally sees any significant sellers. Investors, you most likely won't see those low levels again in April for quite some time, if at all this year. Many institutions got too bearish near the lows in April and de-risked and are already way behind the performance curve in the second quarter. So does that mean that you shouldn't add to stocks? No, because rarely can you pick the absolute level in both price and time, particularly in growth stocks. Here's some great data on the XLK Technology ETF returns over forward periods when momentum turns in its favor like it has recently. It says that the tide has finally turned positive for technology growth stocks. Regardless of the path of the economy and the financial markets over the next few months, the investment team at Oak Harvest will be here, crewing the ship and adjusting our models where we can. Until next week, have a blessed weekend and know that our Oak Harvest team is doing what we can to plan for you and your family's future, regardless of what stage you are at in your career or in your retirement.